Let's start off with the Monetary Policy Committee meeting set to take place later on this week in South Africa. Some say that we could see a cut, given that our manufacturing sector is still under the spotlight and under pressure. But on the other end, we've got the consumption side of things looking far better. In other words, retail sales on the upside, and also inflation pretty much below that key target of between 3 and 6%, and perhaps more so in the middle of that target range. What is your view on the decision later on this week? Because many investors and market players out there divided on the decision.
Yes, good morning, Eleni. I think definitely there's two distinct camps out there. We're in the camp of no change. We think that interest rates are going to remain on hold for the rest of this year still, and that the next move in interest rates will be up only sort of in the second quarter of 2011. But in terms of this meeting, I think the Reserve Bank is probably going to err on the side of caution, predominantly because of the uncertainty surrounding the wage negotiations that are taking place in South Africa. We've had some pretty inflated wage settlements already, and we've seen more and more industrial action. You know, the coal strike at the Richards Bay terminal at the moment has sort of been a case in point. So I think that because inflation expectations could very well and very quickly spiral upwards as a result of high wage settlements, that the Reserve Bank is possibly going to wait and see where these wage settlements actually end up over the course of the next couple of months, because this is the high wage negotiation season. And you know, you couple that with high electricity tariffs, you know, inflation expectations could very quickly start climbing up again, and that would be of you know, a big concern to the Reserve Bank. So we still think that even though certain pockets of the economy are showing still some very sluggish trends and possibly dipping again, like the manufacturing sector, I think as an inflation-fighting central bank, they've got to be vigilant about those inflation expectations, what happens to wage demands.
Looking at the South African Customs Union, of course, major discussions held over the weekend, and it's really about the trade negotiations that have been going on, and of course the trade deals that we have with the European Union. Some say that the discussions were basically inconclusive. What is your view on this?
Yeah, it seems as though the status quo is going to remain as is for the time being. There were a little bit of concern about these trade unions, at least these custom unions, over the past year or so. Tensions started to mount when certain members started to trade with European counterparts. And of course, these custom tariffs that are generated within the region, you know, contribute considerably to some of these neighbouring countries' revenue streams. In countries like Lesotho, for example, it can contribute to almost 1% to their GDP. So we're talking about some pretty significant numbers. And from South African standpoint, of course, these SACU payments have been a thorn in the side of the current account. It's been a big contributor to the current account deficit in the past. And obviously, as import demand now starts to pick up, now that we're coming out of recession, those tariffs are probably going to start increasing, and again kind of feeds into our argument of a wider current account deficit. So at the moment it seems like the status quo is going to remain in place. Discussions are still ongoing, but if we had to see a scrapping of those SACU payments or moderation thereof, I think if anything it will be positive for the rand from a current account perspective.
Just looking at the major drivers for the rand very quickly this week, Michael, we've got those bank stress tests in the European Union. We've got the saga playing out with Hungary, the EU and the IMF, and saying that they need to bring the deficit into the target band of 3.8% for this year and 3% for next year. And of course, consumer sentiment numbers out of the US on Friday, very disappointing. Is that going to be the major driver for the rand this week? Of course, we mentioned the MPC, but most investors out there saying that any kind of move on the rate decision has pretty much been priced into the local currency.
Well, I think international developments still have a huge bearing on the currency. I think if they keep rates unchanged, it will be positive for the rand from an interest rate differential. But just touching on those international developments, sure, the Hungary saga continues, and unfortunately any kind of containment of fiscal deficits is going to come at a price. It's going to be lower growth for Hungary, so it's kind of damned if you do, damned if you don't. And any kind of contagion that comes out of Hungary could spread quite quickly to to the rest of the emerging market kind of asset classes, and the rand could fall prey to that. I think also, we're going to be watching those global growth concerns. As you mentioned, the consumer confidence and a lot of other data out of the States last week was disappointing. And you couple that with some weaker than expected Chinese GDP, and you're seeing that the market is starting to concern itself with the global recovery again, and starting to question whether or not this global recovery is going to be that robust. So we're going to be looking for earnings out of the States that continues, and any kind of indications as to what's happening in terms of the global growth outlook. That to me is going to be key for the rand. And of course, let's see what the MPC delivers up. Not only the decision, but also the accompanying statement will be key.